Hello, this is Nate Gable, Farm Business Management Instructor at Northeast Iowa Community College. Today we're going to review the material presented in Chapter 19 of our text, Farm Business Management textbook. And Chapter 19 covers the capital and the use of credit. So, obviously, our course, Agriculture Finance, is strongly related to capital and the use of credit. And so, I thought we'd cover this chapter today and review some of these things will be reviewed to you. At the same time, some of these concepts will be new. And so, anyway, hopefully this will be of interest to you. In this chapter, we're going to talk about economics of capital use, sources of capital, types of loans, the cost of borrowing, sources of loan funds, establishing and developing credit, liquidity, and solvency. The objectives are pretty similar. We're going to point out the importance of capital in agriculture, illustrate the optimal use and allocation of capital, compare different sources of capital and credit, describe different types of loans, show how to set up repayment plans, explain how to develop credit worthiness, examine factors affecting liquidity and solvency. So, okay, first of all, what is capital? People think of capital as cash, balances in savings and checking accounts, and other liquid funds. But capital also includes money invested in assets. Agriculture has one of the highest ratios of capital to U.S. workers in the U.S. industries. What that means is it's an industry that has a lot of capital per person. So if you think about a farming operation that would own 400 or 500 acres of land, a complete line of machinery, okay, it's not unreasonable to think that farm has pretty close to $5 million of assets. Okay, that's a lot of asset per person. So if you had one farmer, like I said, only 500 acres and a line of machinery, that could be $5 million pretty easily. Whereas other industries, if you had a shoe store in town, that store, if you rented the shoe store, you owned the inventory, you might only have $30,000 worth of assets per person. So agriculture is an industry with a high amount of investment per person. And this is why one of the reasons that we think of agriculture as a business that's roughly uh, you know fairly tough to enter. Many commercial farms have capital investments over 5 million, like I just said. It doesn't take that big a farm today to have investments over $5 million. Let's look at the capital investment in U.S. agriculture. Looking at 2000, this is all looking at from 1970 to today, but it's all been adjusted for 2012 and 14, 2012 to 2014 dollars. So it's been adjusted for inflation. You can see all the way back to 1970 up until the 80s, we had a rapid increase in investment per agriculture because back in the mid 70s, agriculture had a boom like it did about 10 years ago now here, and you can see the boom here, and things peaked about 1981, and things peaked here in about 2015. If you look at this chart, it followed the price of corn. Late 70s, corn price ticked up rapidly. So did land values. So did machinery cost. Same thing happened in the middle 2000s, 2009, 10, 11. We had really good corn, soybean prices, and therefore we had massive increase in land values, machinery, etc. You've probably heard of the 1980s farm crisis. There you see the decrease in equity. Now, what's really interesting though is if you look at the debt over this same time period, the debt actually went down in the 90s and has stayed fairly steady through today's time. So, even though assets have gone up, total debt has actually gone down. Okay, credit is the ability to borrow money with a promise to repay the money in the future along with interest for its use. It is important for capital acquisition and use. Most of us don't have $5 million in cash to go out and buy land, machinery, livestock, etc. Yeah, so we're going to have to borrow it from someone or some business, like a bank. Credit allows producers to acquire productive assets and pay for them later with the income they generate. Yeah, something like a farm might cost you $1 million for farm land. We need to, we don't have the money. If we don't have the money for that farmland, we borrow the money. It's spread out over a period of time, most likely 25 or 30 years, and hopefully over the life of that land or that loan, the land along with other assets in today's economy, most land will not pay for itself. Even over 30 years, it won't pay for itself. But hopefully, the entire farming operation can repay the loan, service the loan, and pay for the land, and so that at the end of the life of the loan, we are 100% equitable in that land. We own it 100%. So, farm managers must decide how much total capital should we use and how should limited capital be allocated among its many potential uses. Big questions. Most of us don't like to borrow a lot of money. We don't like to spend a bunch of money on investment unless we have to. And then most of us have some type of limited capital. I don't know anybody who has totally unlimited amount of money. So when we do have a limited amount of capital, where do we put it so that it gets the best possible return? So what does best possible return mean? It means a high rate of return. In other words, the largest amount of money possible returning for our investment. And then also how fast does it return that money? When unlimited capital is available, the question is how much in total to use. In chapter 7, or when you guys were in farm business management, we talked about marginal value product and marginal cost. If we have unlimited use of capital, we are going to continue to invest until marginal revenue or marginal value product, same thing. Marginal revenue, marginal value product are the same thing. Where marginal revenue and marginal cost equal. So this is the same thing we're going to talk. Well, the value of marginal product of capital is the additional net return before interest payments that results from additional capital expenditure. The MIC of capital is 1 plus I, where I is the interest rate on borrowed funds. That's marginal input cost. And here you see marginal input cost. That's 1 plus interest. We are going to determine where to invest money, where marginal input cost equals marginal value product. In other words, where it can pay for itself. If we can continue to invest money and that investment repays itself, then we're going to make the investment. In chapter 7, we also talked about the equal marginal principle and talked about that as a decision-making rule for allocating limited resources. The use of this rule means limited capital should be allocated among competing uses so that the marginal value product of the last dollar used is the same in all uses. In other words, we keep investing until the return from that investment pays for its cost. That's the bottom line. Okay, so where do we get capital? We have our own owner equity, in other words, money that we have saved up. That's our money we're using. We have outside equity. This is like when we borrow money from a bank or other lending institution, like Farm Credit Services or the United States Department of Agriculture. We borrow money from those institutions. That's using outside equity. Leasing, like renting farmland or renting buildings or machinery. That would be a form of leasing where we're actually just borrowing the use of someone else's assets in exchange for an annual fee. And then contracting, of course, is where we simply may have a contract with a supplier. Maybe we're contracted with another operator to maybe raise our dairy heifers for us. That'd be an example of contracting. Or maybe another farmer provides feed for us. That'd be an example of contracting. Then, of course, credit. Maybe we have credit with our local feed store or feed vendor, and they have us on credit. So, in other words, we need to pay a monthly feed bill. Let's say that would be an example of credit. We get the products that we use for our farm, and we pay our monthly payment. Debt. This is really interesting. I talked just a little bit ago about how the debt for the average farm has decreased, and this is true. It's very interesting. The debt to asset ratio for U.S. farms. If you look at, and this is on January 1st of every year, you're looking at the balance sheet, which you remember from Farm Business Management, the balance sheet, and we learned about the debt to asset ratio uh, on the balance sheet. Debt to asset ratio, meaning the amount of liabilities relative to total asset. The lower the debt, the better. And it's really surprising. The average farm has a debt, according to this, in 2015, between 10 and 15% debt. So that is a very, very, very strong position of the U.S. farm. So for example, a farm that would have $5 million of asset, if it had a debt to asset ratio of 15%, like this is suggesting that the average farm would, you're looking at only $750,000 of liability. Okay, so $750,000 of liability on $5 million of assets. That farm would have a net worth of $4,250,000. Very, very strong net worth for the average person. Okay, this I copied and pasted from Iowa Farm Costs and Returns from the Iowa Farm Business Association through Iowa State University Extension Service. And this shows in Iowa, right here, look, total debt to asset ratio. You can see over from 2005 up till 2014, 25% was the absolute high and actually decreased all the way down to 16% and maybe slight increases now up to 19%. Another interesting figure is the net worth per acre farmed. That does not say per acre owned, it's per acre farmed. The average net worth of the farms involved in the Iowa Farm Business Association in 2014 was $2,805 of net worth per acre farmed. So, say a farmer who farms 1,500 acres, if they had a net worth of $2,805 per acre farmed, they would have a net worth of $4,207,500. Very strong balance sheet. Very strong. So we can talk about loans by the types or the length of repayment. We can look at them by use. We can look at loans by their type of security and by their repayment plan. Let's look at loans by their length of repayment. A short-term loan is a loan used to purchase inputs needed to operate through the current production cycle due at the end of the cycle. So a short-term loan, we should think of a short-term loan like an operating note. It's a very short-term loan. That'd be a 1-year loan. You borrow the money for one production cycle. When you're done producing, whatever it would be, whether it's livestock or row crops, for example, you produce the crops, harvest the crops, pay for them, pay back the loan at the end of the production cycle. An intermediate loan would be one for 1 to 10 years. That's usually for the purchase of intermediate assets like breeding livestock and machinery, buildings, things of this nature. A long-term loan is a loan with a term of 10 years or longer, usually for the purchase of land or maybe a home. Everything else is probably going to be 10 years or less. Maybe something like a dairy barn or possibly a hog barn might be over 10 years. But most intermediate assets like that, like those buildings, are always an intermediate asset. Typically, those are going to be a 7 to 10 year loan. Okay, we can classify loans by their use. A real estate loan is exactly what it says. It's a loan for the purchase of real estate, such as land and buildings, or loans that use real estate as security or collateral. Non real estate loans are all business loans other than real estate loans. Personal loans, non business loans used to purchase items for the family, would be a personal loan. Like a vehicle loan would be an example of a personal loan. If we describe loans by their security, we have what we call secured loans. That is where an asset is mortgaged to provide collateral for the loan. Then we also have unsecured loans. This is a loan that is obtained with only a promise to repay. It may also be called a signature loan. So, if you're not familiar with the word collateral, what that basically means is if you don't pay the loan back to the bank, they can take ownership of the property in which you borrowed the money for. For example, if you borrowed the money for a combine and you use that combine for collateral on the loan, if you don't make your payments and the bank calls that loan, they will take possession of the combine to get their money back. They take the possession of the combine, sell the combine, and return their money. Most loans are going to fall in the category of a secured loan. The types of repayment plans also may differ from loan to loan. We may have a single payment repayment plan. This is like an operating note. An operating note, like I said, you get a loan from your bank. Say you buy a group of cattle, you buy 500 feeder cattle, and you want to borrow the money for the cattle and the feed. Well, that it doesn't take long for an operation like that, a loan like that. It could be pretty close to $1 million loan. You borrow the money, borrow the $1 million, buy the cattle, buy the feed the cattle, sell the cattle, repay the loan all in one lump sum. That would be a single payment loan. A line of credit is a little bit different. That is where we have the ability to borrow smaller amounts of money at any time. So you're constantly borrowing and you're constantly paying back. That may be something as simple as with your local feed store, like I have said before, or your veterinary office. You charge to that account every month. You go in and pay down that account. That would be what we would call a line of credit. An amortized loan, amortized by equal total payments, meaning every month, let's say you buy a new tractor and every year you have a $20,000 payment on that tractor. That is equal payments of principal and interest. If you have a loan that is amortized by equal principal payments, it will actually start bigger and decrease as time goes on because you are decreasing the principal at a faster rate, and therefore your interest is lower. You can also amortize with a balloon payment. This is where we pay off a portion of the loan and then a balloon payment is required, and what you need to do then is secure a second loan to make the balloon payment, or maybe even have the money in cash by then that you make the balloon payment. We'll illustrate all of these here in a minute. So here's an illustration of a line of credit. Here we borrow money on various dates, and here we pay back loan at various dates. You can see the interest paid, principal paid, etc. Here's a looks like an amortized loan for $100,000 at 8%. Here's equal principal payments. Here's equal total payments. Okay, so as I said before, equal principal payment loans start off the actual amount, the amount of a loan paid, the payment is actually larger as we start and decreases because the principal paid every time, every year in this case, the principal is the same, but look what's happening to the amount of interest due. It's decreasing. Okay, here's an equal total payments amortization. Unlike the equal principal payment, where the payments were decreasing, in equal total payments, they are exactly what it says. They're equal. Interest paid and principal paid is the same. It equals the same amount of total payment. In doing this, your principal is not decreasing nearly as quickly as the equal principal payment plan, and so therefore you pay more total interest. You can see in this loan, the total interest paid was $49,000 at the end of the loan, where it was $44,000 in equal principal payment. Why would someone do this loan? Because up front it's a lower payment than the equal principal payment. Why would someone want to do this loan? Because interest savings over time. And that's what we're showing here with these two tables, bar charts. Gray is the amount of interest, white's the amount of principal. Here we're showing equal principal. In the equal total payments, the principal increases over time that you're paying towards the loan. A balloon payment is a periodic payment that are calculated by amortizing the principal remaining after subtracting the balloon payment from the original loan. Interest on the principal included in the balloon payment is added to each periodic payment. So this is kind of confusing. The general formula for calculating the annual total payment for a balloon payment loan with equal total payments is principal, that's the original principal borrowed, minus the amount of principal in the balloon payment times the amortization factor. Then we add back the balloon payment times interest rate. Okay, so for example, here's an amortization of a $100,000 loan over 10 years at 8% interest with a 50% balloon. So basically, folks, what's happening here is this. You're going to, they're going to amortize the because this is a 50% balloon, you're only going to pay back or amortize $50,000, and you're just pushing back the other $50,000 until after the 10 years. So you have to start the loan all over again, basically, because here's what happens. Okay, so we have an equal total payments loan paying back the $50,000, the original $50,000. Um, well, excuse me. Let's look at it a little bit differently. We pay back the $50,000, like I said, but you also pay $64,000 of interest. Okay. Then you need to come up with $50,000 at that time for the balloon payment. So your total payments is $164,500 with all the annual principal payments along with the $50,000 balloon payment. What people usually do in this scenario is then get a loan for the $50,000 from a second creditor to pay this balloon. Then they'll go ahead and amortize this $50,000 from there and go on another maybe 5 years or 10 years and pay back the $50,000. Okay, why would someone do this? Again, to get the the total payments as low as possible so that they can make payments. Here's an amortization of a $100,000 loan over 20 years at 8% interest with balloon payment after 10 years. Okay, that's kind of what I was describing. We Here we go ahead and make our annual payments. Um, we have the balloon payment here at 68,345. Um, okay, why was the balloon so high there? Because it actually started accruing interest, even though we weren't paying it off. It was accruing interest along the way. Okay, let's look at the cost of borrowing. True annual percentage rate should be stated in a loan agreement. A way to compare loans is to find the discounted present value of the series of payments. For a fixed rate loan, total interest payments over the life of the loan are known. In a variable rate loan, the interest rate can change. Okay, that's another thing, another type of loan: fixed rate loan versus variable rate loan. A fixed rate loan has the same interest rate throughout the life of the loan. A variable rate loan is exactly what it says. The rates can vary. So again, where can we borrow money from? Commercial banks, farm credit system, life insurance companies, farm service agency, individuals and suppliers, and small business administration. Commercial banks are the largest source of non-real estate loans in agriculture and also provide some real estate loans. Large share of loans caused in part by large number of local banks in rural communities. Local banks are often convenient. Yeah, most of your families, I'm assuming, obtain their credit through their local bank. They know their local loan officer. That's convenient for them, and they have a personal relationship. Very common. The Farm Credit System was established by Congress in 1916. It's currently a private cooperative owned by member owners. So, Farm Credit Services, for example, would be an example. Supervised, audited, and regulated by the Farm Credit Administration, an independent federal government agency. The Farm Credit System also has 4 regional farm credit banks and 1 agricultural credit bank. There's 81 local associations, and loans can be long-term or short-term operating loans. So Farm Credit Services is a example of the Farm Credit System, and it's a business that is owned by member owners. So people that bank with Farm Credit Services actually own the company, if you will, and have access to credit or borrowed money, and then also have the ability to get a dividend at the end of the year because they're an owner of the business. Life insurance companies can also invest in long-term agricultural real estate loans. Not as common, but it is possible. The amount available varies from year to year depending on the rate of return from the loans compared to alternative investments. Life insurance companies generally prefer larger loans over $1 million. The Farm Service Agency is part of the United States Department of Agriculture and has offices in most agricultural counties. Loans are most often granted to beginning farmers. Farm Service Agency also has authority to make emergency loans after a disaster. The Farm Service Agency has moved toward guaranteed loans. To be eligible for an FSA loan or guarantee, you must be a family size or smaller farm or ranch, receive a large share of income from the operation, and be unable to get enough credit from other sources. You may also obtain loans from individuals and suppliers. Non-real estate loans can come from friends, relatives, supply stores, input manufacturers, or special agricultural credit companies. Many suppliers allow customers 30, 60, 90 days to pay their accounts before any interest is charged and may finance a purchase for a longer period of it with interest. Farm equipment and automobile dealers also provide loans by financing purchases themselves through an affiliated finance company. That's true. Most car dealers today, or car companies, machinery companies, offer Financing within house because it helps them to sell merchandise, obviously, help them sell property, sell machinery, sell vehicles. Financial service companies like private financial intermediaries that secure funds from commercial and institutional investors and use them to provide credit to ranches, farms, and other businesses. Often national or even international in scale, they offer large scale financing packages, may provide other financial and risk management services. We're going to go ahead and take a break here. I will continue the spread or this slideshow with the next half of the PowerPoint, and so we'll go ahead and pause it from here.